Welcome to the Driven to Succeed Real Estate Podcast. I'm your host, Brandon Olson. This is my co-host, Terry Turwido. And Terry, today we wanted to talk about getting pre-approved, pre-qualified, first-time home buyers. What does it all entail? So let's just start with the whole pre-qualified versus pre-approved. What does pre-qualified mean?
Pre-qualification, a lot of people, they'll call me like, well, I've been pre-qualified. And I'm like, well, what does that mean?
Right.
I was like, did you give them any of your docs? Well, no. And I'm like, well, that means you've started the process, which is good.
Right.
Your first step is one step forward. So let's get you pre-approved.
Right.
And how do we do that? Sometimes, like we were mentioning earlier, a guy goes on to Rocket Mortgage and he's like, they pull his credit and like, I'm pre-approved.
Right.
I'm like, well, you're technically not,
Right.
So we just want to go through with that with you today. And it's pretty basic, but some people don't understand it, and we just want to clear the air on
because
it.
we do pre-qualify people all the time,
Yes.
right? The reason why we pre-qualify, we even set up a tech company. I even set a tech company to pre-qualify just to know what's going on. So number one, as a lender, I want to know what kind of loan products I can deliver to them or provide for them, right? But I want to know if they are even pre-approvable, because sometimes you might get somebody that works part-time, right, at a gas station, and they want to buy a house. And, well, do you have anybody that can co-sign? No. Okay, well, then you literally have to say, hey, we're not going to have enough income to qualify. You're going to have to get a full-time job, and so forth, whatnot. But for the most part, when we pre-qualify, we get them on the phone. We go through our framework, right? What do you do for work? How much you make, how long have you been there, what do you have for liabilities? So liabilities are car payments, student loans, credit cards, any other, maybe even you might have a divorce, you might have child support. We want to know that to see what you are pre-qualified for and see if you can purchase that, purchase a home, right? But that's part of our, kind of selling ourselves a little bit, but being able to provide options for them to move them to that next step, which is the actual pre-approval.
I 100% agree. And it just gives us, having a conversation with you, we mentioned earlier, if you just signed a lease and you're like, I got one more year and I'm going to buy a house, guess what? It doesn't hurt to have a phone conversation.
Right.
Let's make this process surprisingly is easy if you set it up correctly.
Right.
If you plan for it. Planning is everything. If you plan for it, I just talked to a guy the other day and he's like, well, Terry, it's now August or September almost. He's like, I want to buy a house in like February, March. I'm like, let's talk next week. Let's just set it up for you, because when that time comes, you're going to be like, this was the easiest thing I've ever done.
Right.
Why? Because we planned it.
And, and a lot of times it will take till that beginning of the year where they actually are now really looking at houses.
Right.
But usually that conversation, when they start thinking about houses, guess what they're doing?
They're excited. They're looking at houses.
Yeah, they're scrolling through Facebook
Yeah.
and they see an agent on there and they check out a house. Next thing you know, they're on Zillow. They're looking at houses.
Yeah.
They get kind of under that ether.
Yeah.
And I've seen it more times than not that all of a sudden they find, hey, this house is the right house in the right neighborhood. That's the price range I want to be in. But if they've only been pre-qualified and not pre-approved, can they even buy that house right now?
No.
And then by the time they get those documents, application in and everything in, that house is gone. I've seen it multiple times, right? And it's so having that conversation with your loan officer or, with us specifically,
Correct.
We want you to come to us. Having that conversation now, there's a lot that we can do. What can we all do at the beginning? What if we have a lower score?
It's getting, if it's a lower score, we can pull your credit. We can figure out if there's room to move.
Right.
We can figure out what steps you need to take. Maybe it's paying down some credit cards. Maybe it's, obviously we all know when you want to buy a house, simple rules. Save.
Right.
Pay down all your debt.
Right.
And guess what? And build your credit score up. There are simple rules to this game that, everything you're paying out every month towards your car, towards your credit, goes against how much you can afford for a house.
Right.
So if you have time, if you have 6 months, if you have a year,
to plan accordingly.
Guess what?
Yeah, I mean,
It's awesome. But
yeah.
some people don't. Some people, I'll say maybe 80% of people shoot from the hip.
Right,
It's I want a house tomorrow.
Right.
I had one last week, and he called me on Friday and said, "We want to put an offer on a house, and it's highest and best due on Sunday." And I'm like, haven't even sent you an application yet.
Right. Right.
So, did we get it done? Yes.
He's motivated.
He's motivated. That's right.
Right.
Luckily, all the stars aligned for him.
Sure.
I did get it done. We
Right.
did get the offer
Right.
accepted. In all cases, does that happen? No.
No, but by getting pre-approved early, we have a chance to look at maybe there's different programs that you could qualify for. Because let's just say you are a renter, you don't have a ton of money saved up. There are down payment assistance programs, right? But maybe there's some different criteria what's going to allow you to approve for that or not, and we can guide you sooner than later, right? Let's say it's a minimum credit score requirement, or we have self-employment stuff that we have to deal with. There's all kinds of reasons why, having a year to shop for, before you're going to buy a home, but talking to a lender early is, there's a benefit to it.
Crucial. And it's hard because like we talked about earlier, it's hard. I tell everybody, you meet your agent, he's the cool guy, and he goes, "Here, call this asshole." That's me. Which technically you should call me first, because then agents are like, "Well, is he pre-approved yet? Is he pre-approved yet?" Well, no, I kind of had to fix his life a little bit to get him set up to get pre-approved. Now, if you talk to me first and we get you set up and all of a sudden you're pre-approved and you go to your agent and go, "Here's my pre-approval letter," he's foaming at the mouth.
Right.
He can't wait to find you a house. It's
Absolutely.
it's easier, but it's hard. Like I said, you mentioned earlier, when you go buy a car, you don't get the financing first. Nobody does.
No, you go into the dealership
to the dealer.
typically
Yeah.
to find your car. So the same thing is you go to the real estate agent, which in turn, a lot of real estate agents is where we have our interviews on here. We bring these professionals on because they are the ones that are primarily getting those buyers, right? They come to them, and then in turn we have the relationship with those agents, because they know that we're going to get the deals done, but they know that we're going to be able to guide them through that process. And whether it's a conventional loan or an FHA or a VA, there's all kinds of different loan types, programs out there. And talking to us first is going to be the reason why. That's kind of one of the first steps in it before
We
you
know
even
those
look at
programs. We know the programs, and we know if you're available, if we can get those programs for you, or a grant in that certain city if you fall within the criteria.
Like you said earlier or before this, nothing in life is free, especially when it comes from down payment assistance.
Everybody.
It isn't, but grants do. There are certain grants, different cities that have, like there's Richfield that has a grant. There's LIFT program, where you can get $15,000, and if you live there in Richfield for 10 years, that's free money.
Free money.
Right? And there wasn't any, besides some small closing fees to go with that second loan, because it is a loan at first, but it's
forgiven.
Yep, it's forgiven over time. But then you have the down payment assistance where you can get monthly payment loans or deferred payment loans to help you with that. Because let's say you have $5,000, you want to buy a house, but your minimum down, FHA is 3.5% on $300,000 is going to be like $12,000. It's going to be closer to $14,000.
Plus closing costs.
Right. Then you have closing costs on top of it. So you need this down payment assistance to help, right?
And if you have good credit, and if you're, it's based on, some of these programs are all based on, you have to make, they're for moderate to lower income, you have to make under a certain amount. Your credit score has to be at a certain level.
Correct.
So, that's why we talk.
And there's some nuances. There's a reason why there's a lot of lenders don't even do them, because there's nuances with them that, from just looking at bank statements, and also they have a bunch of cash apps or deposits from all over the place, and they're selling stuff online. Also, that brings their income up. So you got income limitation. So there's a reason why some lenders just don't want to do them.
That's why
we're very fluent in it. So they're actually easy to navigate if you do everything up front. So let's talk about that. What does it take to get pre-approved? What is that process? So specifically,
you know, it,
filling out the application.
filling up your app, fill it out completely. Get me the documents. You know,
Yeah.
the documents that we need. You know,
Right.
are basically, you know, have things ready. Your 2 years of taxes,
Yeah.
your 2 years of W-2s, your any checking or savings accounts, your last 2 months statements. You know, some people have one account, some people have five. You
Right,
know,
right.
but where's the money coming from?
Right.
You
And
know,
they might have five and they only use one account, so
Right.
they send us, but they have money going to different
In and out
accounts,
out
so
of
we
all.
end up having to get all five accounts after all. But yeah, it's you know, it's pretty straightforward. You do your application. When we send out, you know, the application links, you know, then you complete the application. It says, now will you upload your ID, you know, your driver's license or state ID, right? And then you have your last 30 days of pay stubs, right? Maybe you have a couple jobs, you want to get us all of that information, right? Then you got the bank statements, you got your taxes and your W-2. So it's for a if you don't own another property, it's very easy, very straightforward. You get that, and now we review everything. We make sure that income is correct. You know, maybe sometimes we have overtime, we have bonus pay, we have some commission structures. You know, so we might have to do verification of employment and income to get accurate numbers if we're pushing some tight debt to income ratios. But we do that all in advance before you even start shopping, so that we know what is your max payment, which equates to how much house you can actually afford. You know, is it 300,000, is it 400, or is it more, right? How much cash do you have that you can pull? Maybe we can get 401k funds to help instead of using down payment assistance, because down payment assistance is going to carry a higher interest rate.
Yep.
Right? So there's you know, it's pretty straightforward. Once we get that pre-approval done, that's your ticket to shop.
That's right. Once we get to see everything, basically, I tell everybody, they're like, "Oh, you're sure asking for a lot?" And I'm like, "I technically don't want it, you know, but we have to follow the guidelines."
I mean,
you know, I tell everybody, I'm going to ask you for 100 documents, and when it's 15, it's going to be a lot easier.
right.
You know.
And if we do this up front, you know, we're going to solve those problems up front, so we're not constantly asking you for something else. The reason why lenders only, you know, a majority of lenders, the number is like 17% retain their clients, because it is a process. So we aim to clean that process up, make sure that we button it up, do anything. If there's red flags up front, we're not trying to do that once you're under contract, because now you have, oh, I got to buy this house. I want this house. I want this house. You know, you don't want to lose out.
Right.
But if a lender hasn't done all of their stuff up front, which a lot of national lenders don't always do that, right? They may get a bank statement or two and a pay stub, but they didn't get anything else, and then they find out on a Cavers report something federally happened with you. Now you have to, like, there's a lot of different reasons why I end up saving a few deals a year from the companies out there that are national lenders, because they just simply didn't do everything up front. So, you know, let's talk about saving money. What is like the down payment, the minimum down payment required?
Well, you know, for years and years, parents are always like, you got to have 20% down.
Right.
Well, that's what they did back in 1950 when they were buying a $50,000 house.
Right.
You know, in today's world, no, you can go down to a conventional loan down to a 3% down. You know, it's for anywhere from 3% to 20%.
Right.
I just had someone sold their house and they put down 50% because they wanted a low payment.
Right.
Go for it.
Right.
You know, but first-time home buyers, as little as 3%.
Correct.
You know,
On a conventional loan.
on a conventional loan, 3.5 on an FHA.
Yeah, then you got 3.5. And you can go higher on an FHA, you know, if you have a lower credit score and so forth. You got rural development loans that say you live outside of the metro areas. You can get rural development loans. That's a zero down, but then you still have closing costs.
Right.
Right. But then
VA loan.
VA loan, if you're a vet, you can do zero down there as well. And then there's some other non-conforming type loans out there for self-employed people. Like, say they're self-employed truck drivers. They're notorious for writing, you know, because of their gas, their fuel cost, their maintenance on those trucks. It could be like they can make $300,000 in gross revenue, right, a year, and they write off $250,000. They have $50,000 left, but they know they can afford this $400,000-$500,000
Right.
home, but on paper we can't, right? So there are bank statement loans. Well, if you're making 300 grand a year, you're putting in 20-some thousand dollars a month in paychecks into your deposit. So you have 2 years of bank deposits that we send in. We get it calculated, and they say yes, you're approved for $7,000 in income, which equates to a $3,500 payment. And then it makes the life easy. We don't, in that case, we don't need to get the tax returns and W-2s because, well, number one, they don't have W-2s, but we don't have to do their taxes. That's huge because self-employed people have that problem more than anything is there's a lot that goes into self-employment and how their income is calculated from a Fannie Mae, Freddie Mac, FHA type of loan scenario.
I put a lot of things, like if I'm talking to someone who I know they're pretty much going to be a conventional loan, which 80%, 70% my loans
I
are.
was going to say your loans, right?
Simple rules, I tell them, 5% down is where they'll get kind of the best break in their mortgage insurance. So it's basically simple math. I tell them if you're buying a $300,000 house, you put 5% down, 15 grand, and just say round number, add on an extra 10 grand for closing costs.
Right.
They're like, well, that means I got to save 25 grand. I'm like, yeah,
Right.
it's, but can we work that to be a little less?
Yeah, and to be clear too, 5% down gives you a better mortgage insurance cost than 3% down does. But if you every 10, like you go up to 10%, you go up to 15%,
Right.
you get bigger breaks in that mortgage.
Right.
But realistically, let's just say, bringing up that subject of mortgage insurance, not trying to get too far in the weeds on that, but mortgage insurance today is not like what mortgage insurance was 10, 12,
Right.
15 years ago. So today, after the '08 crash, they forced the mortgage insurance companies to put $2 billion in cash each on hand in case of another market drop, right? So that they can pay out the lenders. What in turn, they got super competitive, and the higher the credit score you have on a conventional loan, and the lower the debt to income ratio, you can get super inexpensive mortgage insurance. I mean, I've seen 5% down,
$50.
on a $350,000 loan amount, and it's $50 because they got 23% debt to income and they got a 780 credit score.
Right.
Right. I mean, $50, and they were going to put 10% down, so but it's only $50 versus maybe $30 on 10% down. And it's just like, hey, that's an extra, 15, on 350,000, that's another 17.5 that you would have to put out of pocket. Well, what if you put that 17.5 into a money market account?
Right.
That's going to far exceed that $20 a month cost, right, for mortgage insurance. And I've had people where instead of doing 20% down, they did 10 because they did the same, right? You can take that 10%, use that money to work for you. Assuming, it's not a payment issue, right?
Right.
Because obviously 10% down on, that there's going to be a couple $100 a month difference in payment.
Right. That's why we come back. It's based on credit. Credit is like sorry to say, the world is based on credit.
Right.
We need the better credit score you have, the better breaks you get. That's why I'm always like, let's build that credit up. And we can help you there. We can get you. There's simple ways to get you there.
Yeah, we have tools that will allow you to, when we put your score and let's say it says 675 and there's a 30-point increase, well, 675 versus 700 on an interest rate is going to be at least a quarter of a point.
Yep.
And a quarter of a point on, say, $400,000 is going to be, $50, $60 a month.
That's a lot of
So
money.
put that over 360 payments. That's a ton of money, right? But what if we get into, again, I like to get into the weeds on a lot of different subjects here, but credit repair, not credit repair, but credit, improving credit scores. What if when we pulled your credit, you had the one card that you used for everything and it was kind of maxed out that month because you went on a trip, right? But you make your payment on the due date of that credit card. Say the due date's the 15th of the month, and every 15th, my payment's due. I'm going to pay the $5,000 off. It's a $7,000 limit. I just went on a trip. I paid that $5,000 off on that due date.
Takes another month to.
Takes another month. So the trick to that, to hack that, is pay that on the 12th.
Yeah, pay it
So
before. If you know
pay
you're going
it
to buy a
3
house,
days, 3 days prior to the due date. Just get in a habit of that because that'll accurately reflect what your score is, what your your statement balance is when they send that snapshot into the credit bureaus, because they only do it once a month. Creditors will only report once a month,
Right.
and they report what that balance is on that due date. So if that balance on that due date is you made that payment that day, even though it says zero that day, it still has to clear all the banks. So it takes usually 2-3 days. So now that balance is zero because you paid it on the 12th, and now your score is a 705 or 745. You know, there's looking at how our industry works, and it's every 20 points. So when we're looking at 620, 640, 660, you know, again, 700, 720, 740, 760. Once you're above 760, it doesn't matter.
Doesn't matter.
Right? And technically speaking, you're probably not getting too big of a difference between 720 and 760, but there's a little bit,
Yep.
maybe some slight nuances. But if we are pulling credit early and we have time to work with it, and we know we got some things coming up that, hey, yeah, I'm going to pay this off. I put everything on my
But that's
annex.
that we would have probably found that out in our phone call when we pre-qualified you. Terry, I just got back from a trip and I have $5,000 on there, but I'm going to pay that off. Well, now we know. So now we know, like, well, if we're not going to buy a house for 5-6 months, guess what? I might not pull your credit till, guess what? Go on Credit Karma, go to Experian Boost. Credit Karma will show you your balances.
Correct.
Pay that off. Once Credit Karma says that balance is paid, now let's pull your credit.
Right. Yeah.
You know, if we have time.
You brought it great, because you can always, the annual credit report is free every
Yep,
year.
yep.
You can get that. But you can always do the free with Credit Karma. Again, Credit Karma is going to usually be from a FICO scoring model about 20 to 30 points higher than what a mortgage company is going to
Right.
pull. And we all have to pull the same models.
Yep.
Experian Boost is going to be the closest FICO scoring model to what the mortgage industry is going to have. So I like to tell people to go to both Credit Karma and Experian,
Right.
set up two different accounts. They'll send you alerts when your score increases. So like you make that payment. Let's just say you made that payment on the 15th. We want to know when we can pull that credit again to get them shopping, because maybe now we're starting to put tight timelines on when they should get into a property because their lease is getting up, and we want to pull that credit at the right appropriate time. So that's when I'm like, hey, pay this balance down, and then when you see it bounce on your side, call me.
Then
And
I
we'll
just
pull
did
your-
it yesterday to someone. Like, she made it. It took her a month and a half, but she's like, Terry, it says my scores on Credit Karma 701. Well, when I pulled it, it's 660, 665.
Right,
Which
but it was what 620
it
before
was
that,
595.
595. So,
So
there
we
you
got
go.
her from 595 to approved loan now.
Right.
You know what I mean? Because she followed these correct steps.
Right.
And she got there. And guess what? When you start seeing those scores go up, it just makes you feel better.
Right.
Every month, like, oh, I'm going to go up again. And
Right.
it's just a feeling of once you get that going, once you figure it out, guess what? Good
Yep.
things happen.
And then, the other thing is, let's say you have a lower credit score. You have that 590 score, but you have a bunch of things on credit that you can't just pay down some credit card balances to get them to approve, right?
Right.
So, we have the partnerships that we have with the credit repair people. And I like to talk more, not necessarily credit repair, but like financial wellness. I have a company directly that I work with, Credit Life, and they are awesome. Number one, they educate you on credit. So you want a credit repair person to really tell you how credit works, or look at your credit profile and say, here's the reasons why, here's what we can do to fix it, here's what we are going to do to fix it. And to give Credit Life a plug right now is, they are awesome. They actually just came out a program. If they can't get you to your score, get you approved eligible loan within 9 months, they will either refund all of your money that you've paid, or they will keep working for you
That's
for
great.
free.
Yeah.
I mean, it's fantastic, because it's not, sometimes it's a lot harder for some people than others.
Yep.
Well,
Well, some people don't have the money coming in. Some people get in a rut and they're like, I lost my job. All my credit cards are maxed. You know what? Some people don't have bigger paychecks coming in to pay out that credit faster.
Right.
You
But
know.
a lot of times for credit repair, maybe the last 3 years they got back on track, but they still have all this old stuff hanging out there, right? And the credit repair people can go in and get that stuff removed, do different things, get you on the right programs to help increase the score. Because there are different ways to do it. Like Fingerhut card. It's kind of a hybrid installment revolving credit. You get a credit line for $500, but you're paying it off over 6 months, and that'll help improve your score because it's kind of a revolving credit. Revolving credit can move the score up and down the most, right? Installment loans, people say this all the time. My car will be paid off in 2 months, my score is going to go up. And that's not necessarily true because you pay that installment loan off, that goes away.
It's done.
You don't have it's gone. It's no longer reporting to the credit bureau anymore to help give you that positive every month report.
I had a retired man who I just pre-approved him, and he's like, "Oh, my credit's at least 820." Well, guess what? His credit was a 750, which is still great. Don't get me wrong. Problem is, his cars are paid off. He doesn't use credit anymore. He didn't.
Well, luckily he has a score because if
He has a
you
score,
go
right.
stagnant for 6 months, you have a no score.
Right. So you have to use credit to get credit.
Correct.
So, let's fast forward. Once you're per se you call and your credit's great and everything, once that process starts, I tell everybody, don't go buy a new car. Don't go buy your furniture in advance. Don't open new credit. Just keep everything the same.
Part of that, yes, opening new credit can totally
Kill you.
kill a transaction. You're under transaction. I've seen it before. People get excited. They buy in this big house. They don't really have any furniture, so they go to Home Furniture, and Home Furniture is running 5 years on a mattress, and they go buy a $6,000 mattress at 0% interest and so forth. And we were pushing tight ratios. I mean, it could push you over the top. You don't approve anymore.
Might not get a house.
We have to take that new payment into consideration, right? So there's a lot that goes into it. So by getting pre-approved early, following our direction, we can easily walk you through, get you fully approved, so you have that nice stress-free purchase of that house. That's the key to all of it.
So, like I said, we just wanted to talk. A lot of our listeners, where they're like, you know what? Because we haven't discussed it. We haven't gone through this before. So I'm like, this is the first steps of everything. And, we hope that you kind of understood it and you like I said, reach out early. There's no.
We're going to be doing some education videos about the processes as well, like asset statements, how to do transaction history versus bank statements, getting us appropriate documentation, what we're looking for from letters of explanation, how to do a lot of these things, because I know a lot of people struggle with it, and it's hard to understand if you've not done this before. Right. So look for those to come up. But again, like and subscribe. You contact Terry or I directly. Ask us any questions. We want to help you out in any way we can.
Thanks, guys.